Okay, before we head into the market outlook this week, let's review the press conference. And yes, I am using a PowerPoint presentation to get this done because printing on the black screen would have resulted in 8, 9, 10 screens. I can get a lot more on this screen. I can also identify the important statements so that you can see them at a glance. I think it might be a little bit more clear. Your eyes are drawn to what the key statements are throughout the press conference. And I have received some feedback from candidates and viewers who do not have English as a first language and learned English from textbooks, that when they see my printed writing on a screen, sometimes they don't recognize the word because it's not in the way that they saw it originally in the book. So this might be a pathway to allowing the presentation to be more accessible for those who don't have English as a first language. Leave me your feedback in the comments section of whether you really hate it, if it's just as good, or if you like it better. So the press conference started with some opening statements, and I think his second sentence, right out of the gate, they are strongly committed to bringing inflation back to the 2% goal, and acknowledged that the full effects of rapid tightening have yet to be felt. They anticipate ongoing increases will be appropriate to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. So repeating the 2% goal quite clearly. So if there was any thought about, well, maybe they'll just raise their target to 3%, they're not giving any light on that one at all. Now this is interesting here. This is in his opening paragraph here. Ongoing increases are appropriate to attain a stance of monetary policy that is sufficiently restrictive. He contradicts himself later on by saying monetary policy is restrictive. In the Q&A session, he contradicts that opening statement. This is, I think, the key takeaway from that opening statement. They expect to maintain a restrictive stance for some time. That sounds like a statement. However, later on, he has it as a conditional statement. You know, a conditional statement is a statement, and this straight line, it means conditioned upon the next statement. So we'll see exactly what it's conditioned upon, because somebody brought up the fact that, hey, the market is way over here and you're way over there. What gives? And then he answered it in the same way as this, conditioned on something. And it was rather interesting. So we'll get to that. Noted that real GDP was less than 1%, or right around the 1% for 2022. Cited it as being below trend, but follows it up very closely with the labor market is extremely tight. Noted that unemployment was at a 50-year low, vacancies are high, wage growth is elevated, but did acknowledge that job growth was easing and wage growth was easing. Well, he said this before he saw the Friday jobs report. However, there is a curiosity in the Friday jobs report that within his Q&A, there was one answer he gave where if I take that and I apply it to the jobs report, it starts to make a lot more sense. And because of that, I'm going to move from the seasonally adjusted to the non-seasonally adjusted numbers in the job report. And they tell a completely different story, because he does make a good point about the business cycle when he answers a particular question. So he acknowledges that job growth is easing and wage growth is easing, but labor market conditions continue to be out of balance. Later on, he refers to the job market as facing very hard constraints. And you'll remember I had drawn out the labor supply curve before, and it was almost vertical, very steep, upward sloping, and that our demand curve looked like this, that if we get any increase in demand for labor, you would get a very small increase in output associated with a very large increase in wage pressure, simply because of the shape of the supply curve. And he acknowledges is that there is a very hard constraint in the labor market. He cites core, year-over-year core PCE at 4.4%. Notice that he's citing the year-over-year. He's saying the last 3 months was a welcome reduction in the pace of increases, but they need substantially more evidence to be confident that inflation is on a downward pace. Later on, he sort of gives a hint that 6 months seems to be what they would consider substantially more. And we've had 3 months of it, so 3 more. Notes expectations remain well anchored. And as far as expectations go, listen, if you ask somebody, what is your expectation for inflation 5 years out, and they give you a number, that's just pure fantasy. But that's not the important part of the expectation. The important part is if they don't expect inflation to be a big deal, they're not going to start pricing inflation into their requests for wage increases. So he does make that note that expectations of inflation are important in creating inflation itself. So you have to make sure that inflation expectations are well anchored. Thus, it will not feed into itself and create the very inflation that was expected. Says there is no wage price spiral, and then follows it up with, we see quite the opposite. No wage price spiral, in fact, quite the opposite. Well, that is a very dovish statement. And when you get to the idea of wage inflation, no wage price spiral, quite the opposite, right? Inflation remains too high. Reducing it will require a period of below trend growth and softening of labor market conditions. He does pull back on this a little later on. He cites the historical record again, the historical record against prematurely loosening policy. And later on, he's asked about the risk of going too far versus not going far enough, and we'll see that answer down here. Associated Press asked a question, financial conditions have loosened since the fall. Does this make your job harder? Do you see rates higher as a result? And he must have been anticipating this question because he looked down and he read the whole answer out. Didn't deviate from the written answer. He didn't ad lib or do anything there. We are not yet at a sufficiently restrictive stance, therefore ongoing hikes are anticipated. That is exactly how he answered it. And as I said, it sounded, based on the pace of his voice and how he was speaking, that he was reading right off a prepared statement for that one. Another question, disinflation seems to be here and has not come at the expense of a weaker labor market. And he answered that with, we are really at the early stages of disinflation. Goods are seeing deflation, but will most likely not last. So he's saying that, yeah, you're seeing deflation, but it will return back to its longer term trend. So he does expect that there will be increases in goods inflation going forward as it recovers from a deflationary period and reinflates. You'll remember at an earlier press conference, he broke down inflation into 3 categories, right? You had goods, you had housing, and then you had services ex housing. So here he's talking about the 3 boxes again here. Goods seeing deflation, housing will rise but then fall. Again, this is a conditional, right? But will fall conditioned on if new leases continue their disinflationary trend. Services ex housing, very clear here, not seeing any signs of disinflation yet. But said, and this is what the market picked up on, I think, more than anything, it is gratifying to see the disinflationary process getting underway, which, made the market think, aha, we're at the end. This is the last one. They're going to pause, or maybe there's one more and they're going to, what's that ugly word again, which has not made any sense since it was first spoken? Pivot. They're going to pivot. And I think one thing is clear. They don't plan to unless the economic data is really bad. They have no plans to. But I don't know that he should have said this line. He sees average hourly earnings and the ECI abating, but still at elevated levels. Openings, when he was asked about the level of openings, he downplayed the openings, suggesting that maybe this is taking a back seat now. He says it's valuable, but wages are coming down, but by many indicators, the job market is still strong. Sure, you're seeing it come down. Job market is still strong. He kind of downplayed openings, so maybe JOLTS isn't as important to him right now. Question, and I thought this was an interesting question here. What does ongoing mean? You say ongoing increases in the overnight rate. What does that mean? He basically avoided the question altogether by not saying what it meant. He said it will depend on the data coming in. And he said it is difficult to manage the risk of doing too little. This rising, stopping, and then having to rise again, and stopping, then having to rise again, and stopping. He thinks it's easier to do this, and then, if need be, come down. Less risky to go too far, because in discussing that, he says, if we go too far, there are things we can do to correct that. But if we don't go far enough, there's only one thing we can do, and that's continually increase rates. So let's go too far. And if we need to cut, we can do that, but let's not make this mistake over here. Okay, I get that he's saying that. I do. But if we go back to his press conference in July, what did he do? He pulled an Arthur Burns. And then he had to come out and talk tough, and they had to raise rates. And what did he do in the February? In this one here, he says more stuff like this later on. He says more stuff that gives the market the idea that, hey, they're pretty much done. He pulls another Arthur Burns. So he is really doing an Arthur Burns, but in press conferences, not in the rate decisions. I really do think that he should stop doing press conferences because, he was a lawyer, or he is a lawyer by training. Can you imagine him doing your closing arguments in court? And you trying to convince him, oh, can't we have the second chair do the closing arguments? Do you really have to do the closing arguments? Because, maybe he's a good lawyer and then he blows his cases in the closing arguments because, I don't know, press conferences just don't seem to be his strength. Okay, returning to that concept of core services X housing, he cites it again. He notes it's 56% of core inflation. And he says it again, we do not see disinflation there yet. Therefore, there is a lot of work left to do. Then he ties labor market to it. He says about 55 to 60% of this component, of this 56%, is labor market driven. And also mentions the mandate is headline PCE, not this particular measure of core PCE. So that even though he's referring to this, the mandate is headline PCE, which has other components that are disinflationary and deflationary, even while this is inflationary. So yeah, we are looking at headline, but we are paying attention to this as well, but we are going to be driven by headline. Sees more persistent inflation in this particular bucket here. Will take longer to get down. Wall Street Journal. Question, why not stop here? Wage inflation is coming down with unemployment at a 50-year low. And the answer is, our assessment is we are not far from that level, seeing disinflation in core services X housing. Then he runs down a list of reasons why he should stop. Real rates are appropriately positive. Policy is restrictive. He said twice that they have to get to a sufficiently restrictive level. And in this answer, he's saying policy is restrictive. Real rates are appropriately positive. We're really just fine-tuning now. And it was followed up with, well, what were the conditions for a pause? He didn't answer. He says the minutes will be out in 3 weeks. Well, is he sort of tipping his hat a little bit here, saying yes, maybe we were discussing a pause or what a pause would look like? Minutes are going to be interesting. CNBC asked a rather, I think, blunt question. And if you strip out all the, with all due respect, and you're doing a wonderful job sort of things, but nothing matters before the but. Somebody tells you you're a wonderful person, everything is nice, they really respect you, but, you can ignore everything in front of the but. This is the core of the question. 3-month PCE is less than the 2023 September estimate for where core PCE would end by the end of 2023. If you go back to September, the summary of economic projections estimate that was given in December. The core PCE, the 3-month now, is lower than what they thought the year end would be. Maybe you don't understand inflation. Oh, but didn't ask it in that kind of way. Just said, is there perhaps some thinking that you don't quite well understand inflation? He's basically saying, you guys don't know what you're doing, do you? The answer, 3-month is volatile. It's driven by significant negative goods inflation. That will not continue. It will move back up soon to its longer-term trend. He expects core, this is Powell, we expect core PCE to move back up to 4% by mid-year. So even though it's coming down right now, he's saying, well, there's one component that is showing deflation. Housing is still going up, but will come down later on, but we know that. It's this other sector, this other bucket that isn't showing any disinflation yet. So if we just pay attention to the 3-month PCE, it's going to be dragged down by one component we think is just simply going to reverse back up to 4% by mid-year. Not going back to 2% in core services, ex-housing, without a better balance in labor markets, facing very hard labor constraints. And then there was a question sort of just shouted out after that question, can we get there with 5%? And the answer, absolutely it's positive. Absolutely it's possible. 5%, we're at 4.75. That is indicating one more. Yeah, he's basically saying, yeah, we can do it. Absolutely, it's possible. Okay, here's where he talks about the business cycle and the difficulty of looking at the historical record to see what all the data means now. This is not like other business cycles in many ways. Gives his base case, 2% inflation, that they can get to 2% inflation without significant economic downturn and without significant increase in unemployment. Admits that most forecasters agree that's not the most likely, but there is a chance. Well, of course he's forecasting this, right? I mean, think about your own life and situations you've been in where you have a problem. And you think, well, I'm just going to do A, B, and C, and to solve the problem. If you didn't think A, B, and C would solve the problem, A, B, and C wouldn't be your plan. So in other words, I got a problem, I'm going to do A, B, and C, but it won't solve the problem. Wow. You have to have some belief that A, B, and C will solve your problem or you wouldn't do it. So the FOMC has a plan in place and they're doing it. They have to believe that what they're doing is going to work out. Otherwise, they would change their plan to get to a plan where they thought it would work. So if you have a problem, and we'll write the word problem over here, you would start devising strategies to try to fix that problem until you hit on a strategy you thought would solve that problem. That would be your strategy. And if I said, do you expect it to solve your problem? You'd say yes. Because if you said no, that wouldn't be your strategy. If they didn't think this would happen, it wouldn't be their strategy. So of course they expect that to happen. Once they don't expect it to happen, then they'll change their strategy. So it's not as if they have this magnificent view of the future that nobody else has, that they have this ability to see what nobody else can see because of where they happen to be sitting in that room. It is, the future is unknowable and it's complex. So nobody really knows what's going to happen. They think they can engineer a particular outcome, and that's what they're going to do. If they felt that engineering wasn't going to get the outcome they wanted, they would have followed a different plan, such that whatever pathway they happen to be on is the pathway they feel this will be the outcome of. Anybody would do that. That doesn't mean it's going to happen. It just means if you didn't think it was going to happen, that wouldn't be your plan. You'd have a different plan, and the plan you're presenting is the one that you think is going to result in the outcome that you want. Bloomberg's question. Recent indicators point to a recession this year. Are you concerned? And his answer was, we believe growth will be subdued, but will continue at about 1% real GDP. There will be some labor market softening, and PCE will move down slowly. We are at the early stages of disinflation, but then said, we are now in disinflation. It will spread, but it's going to take some time. We are now in disinflation. Not appropriate to cut rates this year, conditioned on if we get what we expect. Market expects inflation to fall faster though. So that's the conditional right there. If our base case happens, 1% growth, some labor market softening, PC moving down, we don't see ourselves cutting rates. If that's the outcome, we're not going to cut rates. The market thinks that inflation is going to move down a lot faster than what we do. We don't care. We don't care what the market thinks. So he's basically at this point almost abandoning financial conditions and saying, yeah, that's what they think. We just don't agree. we see a different outlook, and we're not going to cut rates if the future unfolds as we expect. But if the market is right, and he says that down here, if the market is right, sure. Fed funds futures is pricing in one more rate hike. Answer, I don't care. He repeated the FOMC expectations. Inflation by mid-threes by year end. The market expects faster. And if so, well, maybe, sure. Maybe, sure, yeah. If it unfolds the way the market thinks, why not? You know, what makes the people in the FOMC in that room any better at forecasting something that's unknowable than the market? There's nothing, right? They just disagree on their forecasts. Financial conditions are looser. Are you concerned? Answer, we see no difference between the December meeting and the February meeting. Financial conditions have gone mostly sideways, which is really not what, when we look at the adjusted National Financial Conditions Index, the Financial Conditions Index, even the Bloomberg Financial Conditions Index, Goldman Sachs Financial Conditions Index, all have said financial conditions have loosened over the last 2 months. And he says, we see no difference. And that all this is going to require time and patience and rates higher for longer. If we get what we expect, inflation coming down slowly, but acknowledges that the market has a different opinion and the market can have a different opinion. It appears they're not even looking at financial conditions anymore. Or maybe they're thinking, hey, you know what? We were wrong in the beginning. We were wrong a couple times. Maybe we're wrong now and the market has it right all the time. Maybe we should just let the market do what it's doing and follow along. Either way, I don't know that this press conference got done what they wanted to get done. However, I will end with saying this. I really don't think that the Fed actions are the most important thing going forward right now for determining the direction of markets, because we don't make money based on buying the Fed. We make money based on buying and selling the market, so we have to be concerned with the market. Last year, the Fed was the market. I don't think in 2023 the Fed will be the market. I think the Fed will be a variable in the market. So if we had a regression, return on the market equals alpha plus, we have all our independent variables plus B2, another independent variable. I think it's an independent variable. Last year, it was this, with the Fed being the only independent variable. I think you have other independent variables at this point in time, and I don't think the Fed is probably going to be the most important one, although it will be a factor. I just don't think it's the most important one, so I think we can start to put this, the Fed, sort of in the back seat. Well, with the minutes, not the minutes, but the press conference of the Fed behind us, let's have a look at what happened to rates. And Friday really was a big day for rates moving back up. They had decreased. The day of the Fed was rather curious. They had raised 25 basis points to 4.75, but the 10-year, the market cut the 10-year rate by 12 basis points in the same day. So while money market rates had gone up on the short end, capital market rates were being cut. It seemed rather odd. Here's where we are now. You can see right across, we're basically green, but not much. Week over week, really, given what we had all week, they're kind of just small moves here and there. Money market rates since the beginning of the year are all up, but capital market rates since the beginning of the year are all down. Now, one thing I'll say for Powell, he did say that he didn't see financial conditions had changed from the December meeting to the February meeting. We have the 10-year at 3.53 here. The December meeting, the 10-year was at 3.52, and it's at 3.53. So if he was just looking at rates and where the market happened to be, where equity markets happen to be, he was right in a certain sense that, you know, they fluctuated up and down in the intermeeting period, but little changed period over period at 3.53. When he was doing his press conference, the 10-year did drop during the press conference. It got down, I think, about 3.39. But before he came out to do the press conference, the 10-year the night before had finished pretty much where it was at the last meeting. So if he was just looking at those rates, he did have a point there. But we still have rates cut at the capital market level. Never too soon, right? FOMC, March 23rd, 45 days away. But we do have some interesting things this month. In 9 days, we'll get CPI for the month of January. This happens February 14th. And then we get the minutes of the February meeting in 17 days. Next week, you do have some Fed speak. Tuesday, you got Powell. Let's see what he has to say. And then you don't have much. You've got Barr twice, you've got Williams, you've got Waller twice, and Harker next week. Yield curve inversion, 2 to the 10s, negative 77. Not getting any deeper, hanging out around there. It's now been 214 days. The 3-month to 10-year has steepened a little bit, 4 basis points there, 102 days now on the inversion. It is worth pointing out that the 3-month 10-year has a 100% track record of inverting in front of recessions. And every time it does invert, there is a recession. And both of these have a 100% track record when they invert for at least 3 months or longer. So based on yield curve inversions, the recession, based on past experiences, recession is pretty much 100%. The 3-month forward rate in 18 months minus the current 3-month rate inverted 136 basis points. That's unchanged week over week, and I'm using 3-month SOFR to get that done. The effective federal funds rate is now 4.58. It was 4.33, so that reflects the 25 basis point hike on the Fed funds rate. The reverse repos actually increased for the week by $37.5 billion, and it is now at 4.55. Remember, the previous rate was 4.3, so it has found its way in there. It finds its way in there rather quickly. For the balance sheet, still continues its downward march, and in the press conference, Powell said that will continue on. He called it a significant reduction in our balance sheet. It lies ahead of us, a significant reduction. Another 38 billion, so we're at 7.922 trillion versus 7.96 trillion. For those of you interested in the components, it's all U.S. securities. T-bills down by roughly 1.2 billion. Treasuries 33 billion, and floating rate notes. These are Treasury floating rate notes down by about 3.8 billion. Looking at the handicap for March 23rd, FOMC, all the weight is on 25 basis points. Nothing out of zero. I have last week over here. This is the week before. Now, last week we didn't have this because last week was for February. But if you look at the Fed Watch tool at the bottom, there's a grid where it says 1 day before and then 1 week before. 4.5, there was some probability of a rate of, I wouldn't say it's a rate cut. We have to read it in context. 4.5% implying not a rate cut, but that there would not have been an increase in February or March. That was 0.2. But 4.75 was at 15.5, meaning that we only had between February and March 1 rate hike at 15.5, and then getting up to 5 was 84.2. Well, getting up to 5 is now 99.6. And there is just a smidgen of weight on the 50 basis points. If we look at where we're going to end in June, 4.5 to 5.75, no weight on the 4.5, no weight on the 4.75, because that's where we are now. 29.1 at 5, 57% at 5.25, and some weighting at 5.5 versus the week before. Notice that a lot of the weight here was at the 5, 51.7. That has now shifted up, 57 up to 5.25. So going into the February FOMC, even Thursday, even before we got the jobs report, the thinking was split between we're done and we only have 25 basis points to go. That is now seeming to be split, if we look at June, between one more rate hike versus two more rate hikes to go. The weight at 57% here is on two more rate hikes by the June meeting. Okay, real rates have all gone higher, and if we are looking at the REIT sector and judging the direction of REITs, they respond more to changes in real rates than they do to changes in nominal rates, because nominal rates could increase, but if net operating income, NOI growth, increases because inflation increases at the same pace, it's not as sensitive. Real rates are the big thing, and what we saw on REITs on Friday was a significant pullback in REITs, which kind of makes me happy that I was lightening up on my apartment REITs when real rates were dropping as they were going up, because the cap rates just didn't seem to make a lot of sense. If we assumed higher for longer, then they were off. The REIT space, I think, is fairly to slightly overvalued if we accept higher for longer. And if it's fairly to slightly overvalued, it doesn't mean it's selling off, but where's my upside? I'd rather move out of that and start looking at other sectors that might have some upside to them. Break-even rates have all decreased, which is consistent with real rates rising faster than nominal rates are rising. This is the Fed funds futures curve, and usually you'll see one line on here, but I grabbed it Friday night because the move on Friday was so significant in the Fed funds futures. I wanted you to see the difference between where we ended on Thursday night and where we ended on Friday night. This is an index, right? So as the index goes down, it means that our estimate for the Fed funds rate is going up. So we can see that it really pushed down, implying higher federal funds rate. Last week, June and July were pretty much equal, with the index bottoming at 95.095, implying a rate of 4.9. Policy range anywhere between 4.75 and 5. Probably 4.75 to 5 would probably have been the better consensus. Well, now we're below 95, 94.97, so we're sitting at 5.03. So we are pushing up towards the higher end, 5.25. And if we look at where December is ending, December is 95.29. The week before was 95.455. By the way, that is a big move in one day, 16.5 basis points on the way down. That implies a rate in December of 4.71, or somewhere between 4.5 and 4.75. Being that it's so close to the 7.5, I'd say it's 4.5 to 5, or 32 basis points lower than where we are in July. If we look at the 1 year forward rate, the 1 year forward minus the current 1 year rate, we're inverted 98 basis points. It's the same 98 last week. That is suggesting that within 1 year, the market is expecting that the cumulative changes over the course of that year and what is forecast for the next year would total 98 basis points, with 32 potentially coming, or at least the market pricing in 32 by December. If you go past that into December 24, look at December 2023. This is using 1 month SOFR. December 23 to December 24 is another 161 basis points. So if we take the combination of what the market is pricing in here with this, you're looking at roughly 200 basis points of cuts by December 2024, assuming 25 basis point cuts at a time, sometime over the next 23 months. Between going up, the market is also pricing, from this point, pricing 200 basis points lower into 2024, which all of this is not this so much, but all of this up here is leaning towards the market slowly coming to the higher for longer stance that the central bank is putting out. Looking at TLT actually had some good moves during the week. I mean, you were pushing up over 109 here on Thursday. There is your jobs report in the morning, and then all day long it just went sideways after that. But a repricing of those yields on the long end of the curve right on the report. But TLT was just, after this is the Powell press conference, yields just dropping, prices just rising. And then even the next day, some more excitement about it. TLT really taking off. Same with SPY really taking off, and then this happened. For the week over week, TLT is only down 0.46. That is not bad. Week over week to only be down 0.46. Now we have CPI coming up, and the consensus, I think, leading into this, and the story leading into this, it's going to show yet another month of declining inflation because the market tends to keep betting on a trend that's in place. So we've had 3 months of it coming down. The bet will be, well, it will come down again. And if it comes down again, the thinking will be, the Fed has its position, but Powell in the press conference says, yeah, the market has theirs, and maybe the market is right. And if they are, well, then maybe we will cut. Maybe we will stop early. Maybe we will do what they're thinking. Which means if it does come in rather benign or comes in lighter than expectations, you could see this increase again. So I think this is not a trend. I think that is a reaction on the event. And as we move further away from that and closer to CPI, the narrative will begin of, hey, if we create all those jobs and we can get unemployment rate lower and average hourly earnings only go up by a certain amount. We saw the ECI for the fourth quarter coming in at 4%. We have anecdotal evidence that prices are coming down here, prices are coming down there. The momentum of that story could build into the CPI period. So I don't know that I'm willing to do anything on TLT just yet. I want to hear what the momentum of the story is next week. And then if it's strong, I think TLT will move up in anticipation of that. If I want to hedge, I would be more willing to sell, because I have 110 calls, I'd be more willing to sell calls above 110 in case there was a pullback than I would be at this point in time to sell puts, because selling puts is betting on a number. And I don't like betting on a number. I like to see the outcome of the number, and then I know that I have a better informed bet at that point in time. Not a lot of premium here. Look at this, getting squeezed out all the time. If we look at the implied volatility percentile, 13 weeks, 0%, 26, 0%, 52, 2%, versus the week before, 0, 2%, and 5%. Even with all of this, implied volatility just keeps dropping. Okay, let's move on to OAS. Now, we don't have Friday's OAS because this is an OTC market that's fairly illiquid. Everything has to get reported to Trace, and then at the end of the day, you're able to come up with some numbers, and that's reported, I think, by 9:30 the following day. So we won't know till Monday what Friday was. So this is as of the end of the day Thursday, where everything seemed to be just absolutely great. This is also without the impact of all the negative earnings we had Thursday after the close. And I'll talk about earnings a little later on, but none of it was very good. A couple here and there, but the general theme overall was that, wow, this really sucks. And wait till we see what happened to the earnings forecast going forward. A big drop in earnings. So this is not in here. So we're missing a pretty important day. So next week will tell us a little bit more. But look at these spreads. Look at the CCC coming in under 10% at this point in time. So even going into Thursday night, looking at these rates, this is the yield and this is the spread, right? So if we look at U.S. high grade, a T-bill, the 6-month T-bill is at 4.82. The 1-year rate is at 4.79, and going into a high-grade bond, in other words, taking credit risk, is 4.9. Now, I know that's for the whole category, and we're looking at a 6-month versus 1 year. If you look at the 1 to 3 year segment of investment grade, it's at 4.9, which means you're getting 8 basis points more than the 6-month T-bill for taking on credit risk. Mind you, fairly safe credit risk, but you're still taking on credit risk. You're going to get a wider dispersion of outcomes for another 8 basis points. Or if you look at the 1 year, 4.79, it's an extra 11 basis points. Just seems that you're really not getting a lot for taking on some credit risk. Down here, let's just jump down here. I'll tell you what I did down here. If we look at what the 3-year U.S. Treasury is, it is 3.96%. So what I did was I just calculated the forward rates. This is the 1-year rate, this is the 1-year rate 1 year forward, and this is the 1-year rate 2 years forward. And if you multiply these out and take the third root, you should get the 3-year rate. That's, if you've been through level 1, you know how to calculate forward rates. All I've done was calculate forward rates, and you can chain them. It should equal the 3-year rate because the forward rates should be no arbitrage. Otherwise, the forward rates wouldn't be those rates. Well, between the 1 year and the 1 year forward is a drop of 99 basis points, followed by another drop of 52 basis points. So this is implying over those 2 years a drop of 151. We saw on the previous screen, if we look at December 23 to December 24 using 1 month SOFR, is suggesting a drop of 161. This is 151. They're tracking very close together. Why do I do this? Let's assume for a moment that we accept the Fed's statement that rates are going to be higher for longer. That means, again, now we get 4.79 on a 1 year. You get 4.9 on a 1 to 3 year. So let's assume that we go to the end of the 3 year. If you take this, you can lock in 4.9% guaranteed for those 3 years. However, if you're taking the 1 year and you roll it forward into another 1 year, and then a year later you roll it forward into another 1 year, if we believe the forward curve, you'd only get 3.96 as opposed to 4.9. So that is more than just the 11 basis points because you're averaging over time. Well, let's break it down. Do we believe 3.8? If we believe higher for longer, will the 1 year in 1 year be as low as 3.8? Will there be 100 basis points of cuts over the course of the year such that the 1 year in 1 year will be roughly 100 basis points lower? If you think no, then this would be higher, then this has to go higher. And again, if you think that there will not be 151 basis points of cuts over these years, then this rate would be higher, then you would be higher than the 3.96 on a 3 year by rolling over the 1 years. So, it's just a way to ask yourself, if I believe the 3.96 on the 3 year, and I'm getting 4.9 here on a 3 year, I'm actually getting 94 basis points for taking on what seems to be rather benign credit risk because it is high grade. I'd get an excess return of 94 basis points above the 396 reference rate. However, if you do not believe the forward curve, the 3.8 and then the 3.28, in other words, you say these drop in rates are not going to happen, then you are not going to get the 94 basis points. And if you believe that, then this yield is too low. In other words, these bonds are just too pricey because that yield is too low. We'll only see over time, but we have to take the Fed at its word that if they are going to get this nice soft landing and just stick the landing nicely, they're going to be higher for longer. These corporate bonds here and even these over here are currently overvalued based on where we think the forward curve will be. That if we think the spot curve will not drop, we have an inverted spot curve. So if it evolves to the forward curve, it means it's going to drop. If we think, no, we're going to have a stable curve for a period of time, yes, we're going to live with an inverted curve for a period of time, but if it's going to be stable, these are overvalued at this point. Look at our mortgage rates. And again, this is as of the 2nd, right? This is before Friday's report, 6.09, down another 4 basis points week over week. But Mortgage News Daily, which tracks mortgage rates differently by observing actual rates, increased 20 basis points alone on Friday. So this might be back up to 6.3. The mortgage apps week over week were down 9%. Refis were down 7.1, purchases down 10.3. It seemed that there was a a flurry of activity earlier in the new year, and then it sort of just died off. Also with car purchases, if we look at the run rate for January's car sales in the U.S., you're about 15 million run rate, up from 13, mid-13s, low 14s, you're at 15 million. The two biggest interest rate sensitive sectors at the beginning of the year came out of the gates running: housing and autos. But we are seeing that the refi is sort of falling back here. Housing price index down 0.1%. This is November. This is a month over month. That's down 1.5% annualized. That's a look forward basis. If it's dropped 0.1% month over month, that means annualized, that's 1.5% run rate. Case-Shiller down 0.8% for November. And 6.8% year over year. This is empirical. So if you look at the price in November, you look at last November, the price is higher, but only 6.8%. That is under double-digit numbers at this point. Home builders still continuing to impress. Pulte Homes reported earnings this week, and if you saw the price reaction, I think they were up some 8-9% on earnings. $3.63 per share on an adjusted basis. That's up 45% over the the same quarter the year before. Closings for the quarter were up 3%. Revenues for the quarter up 20%. Margins increased by 200 basis points for the quarter. Their debt to total capital, another way of saying it is debt to assets, decreased down to 18.7%. And their ROE 32.9. I don't know that you could have delivered a more perfect quarter. The bat connected with the ball, and it's over the green fence at the back of the field. This is right out of the park on the first pitch. And all the homeowners, all the home builders have been delivering these rates. But I think the future is going to be heavily dependent on this rate. If this rate, if we see this rate continue to come down, or volatility on the treasury component starting to drop, and the spread between the 30-year and the 10-year continually drop, I think homeowners can do quite well. Okay, let's look at the ECI. That was out on Tuesday, and no matter how you look at it, it is pretty good. Civilian workers, if we look at, I actually looked at the index, not just the 1%, and calculated the difference in the index and annualized it. Just for the quarter, annualizing the quarter, 3.953%. For private industry was 3.956. For state and local, 3.94, all fairly close to 3.95. This is from Fred. This is the ECI index itself. Here is 5.1409, which is this number over here under this column. So it is updated for Q4. However, all of these numbers are lookbacks. All of these numbers are lookbacks. If you take this number here, this is the quarter annualized, which is a forward looking. So if we think 3.9, that's about 4%. We're basically there. And we think about a long term, somewhere around 3%. It is getting there. The quarter, how I get the 3.953, in case you're wondering, we are at an index level of 155.5. The previous was 1.4. Since this is a quarter, just divide the two and raise it by the power of 4 and take out the 1, and you'll get 3.953% on an annualized basis. So it is benign. It is coming down. I don't think that we can argue about that, which is what we need to see. We need some more slack in the labor market. Now, we're going to go on and look at the jobs report, but there is a curious thing going on. The jobs report, if we look at just real numbers, in other words, people, there is no new slack in the labor market. It's still extremely tight. Yet we are getting wage disinflation at this point. So I'm a little bit skeptical of the numbers. Primarily, I've been using the seasonally adjusted numbers. And I think that the seasonal adjustment probably is not going to work for this period of time because it is significant. It's a significantly different kind of cycle that we're in for different reasons. as Powell said in his press conferences, we can't just go back and look at the last 10 periods we had that followed a pandemic. They don't exist, and such that this business cycle is not like past business cycles. And if that's the case, then the seasonal adjustment cannot be like for this period cannot be like last previous seasonal adjustment. So I think there might be something with the seasonally adjusted data, because these numbers are not matching what the real numbers are saying, which is the people count. But the people count is based on a seasonal adjustment that may be inappropriate to use at this point. Okay, let's look at some data that came out last week. We had ISM manufacturing PMI. Previous was 48.4, now at 47.4, further into contraction. We also got construction spending came in negative as well. Notice this for the month of December, whereas ISM is for January. So we have a number of sub-indices. Employment, 50.6. The forecast was for 49, but still lower than the month before, 50.8 down to 50.6. New orders, 42.5, really dropped. This had been revised down to 45.1. This is now 42.5. New orders is a leading indicator because it is what is in the pipeline moving forward. Prices was 39.4, increased to 44.5. That's not a good move, right? Then we get some JOLTS information. Openings actually really jumped, almost 750,000 to over 11 million. And quits still elevated. Now this is a real number because you can actually count the number of quits. So that is a real number there. Let's look at what happened. Let's see, we'll expand this one here for the more information on the job market. Let's see if we can sort of just cover this top one up here like a little bit bigger so there's no confusion here. Continuing jobless claims, 1655. Forecast was 1677. The week before, 1666. So that is better. Look at this. Initial jobless claims. These are actual numbers here because, well, these will be seasonally adjusted, but you can actually count them because people walk in and they file an initial claim. Previous was 186. Forecast to go up. Denies it. Non-farm productivity. Increase of 3%. That is good for earnings. And unit labor costs 1.1. Still more information coming in on stresses in the labor market as far as wage inflation. Unit labor costs. That is a function of how much are you paying in extra wages and what kind of increase in productivity are you getting. So wages can go up, but if productivity goes up even more, you can actually get your unit costs down. Unit costs still going up, but less than forecast. What is the next thing that we're looking at here? Factory orders. I'll just expand it down here. Factory orders came in at 1.8. The forecast was for 2.2, but the previous period was negative 1.9. This is for December. But if you take out transportation, because aircraft, I think, made up a big part of December, you actually have negative 1.2, pretty much in line with where November was. And finally, we'll look at our Friday. Let's expand this here. We'll put it here. This is the non-manufacturing PMI, 55.2 from 49.2. The forecast was for 50. That is a significant increase, 10% increase in the diffusion index. For employment, 50, neither expanding nor contracting. That's right on the middle line. Business activity increased to 60.4. New orders 60.4 from 45.2. Significant there. Prices 68.1. Gave up a little bit to 67.8. Okay, let's go through the jobs report that was released on Friday. And I have Powell's statement about this is not an ordinary business cycle, ringing in my ears as I look at the seasonal adjustments to this, because seasonally adjusting something is looking back over a number of years and adjusting for seasonal variations that we would expect to see. Smooths out the data so we don't have these big seasonal fluctuations in. Well, if this is not an ordinary business cycle, would those seasonal adjustments sort of distort the data at this point in time? So I dug a little bit deeper into some of the numbers. they're just not adding up. They're just not making a lot of sense to me. So I'll show you what I found. The January report that we have now is after adjustments. Every year there's adjustments made to the assumptions behind population growth because you can't count them every year. So you have to make assumptions from month to month how the population is growing so that you can determine what the size of the potential labor force happens to be. That's how you get to your numbers of how many people are employed, how many are unemployed, what is the unemployment rate, what's the participation rate. Those are all throughout the year based on assumptions. And then every year there's an adjustment made for better information, saying, well, we got somewhat better information. I think this is a better starting place to start January at. So there are adjustments made to that. So December to January is not comparable in some of the statistics that you get because January is reflecting the adjustment, but December did not reflect the adjustment. So they do make some statements about how we could look at the statistics and what they would have been without the adjustment. In January, both the labor force participation rate at 62.4 and the employment population ratio at 60.2 were unchanged after removing the effects of the annual adjustments to the population controls. So we saw participation rate go up in January, which seemed, in the right direction. Yeah, okay, people are coming into the workforce. Are they though? When I started looking at the numbers and I said, well, I don't know if I can trust the seasonally adjusted. Let me look at the seasonally unadjusted and see what we have there. If we take out the adjustment for population, the labor force participation rate was actually unchanged month over month. It appears to have increased because of the adjustment for population. These next two paragraphs are interesting. The number of persons employed part-time for economic reasons, 4.1 million, little changed in January. And it gives you the definition of what these people are. These individuals who would have preferred full-time employment were working part-time because their hours had been reduced or they were unable to find full-time jobs. That doesn't kind of fit with the JOLT survey, which is 10.5 million open jobs. We keep hearing it's a tight labor market. Companies are competing for labor, yet you have 4.1 million workers that are working for economic reasons. They want a full-time job, but they can't find one. The next paragraph is just as troubling. Not in the labor force who currently want a job. 5.3 million in January. 5.3 million want a job, but they're not in the labor force. Well, what does that mean? It goes on to explain that these individuals were not counted as unemployed because they were not actively looking for work during the 4 weeks preceding the survey or were unavailable to take a job. So if we take the 5.3 million, let's ignore the 4.1 for now. These 5.3 million, they're not in the labor force. They currently want a job. If we go down to the household survey, and we'll come back up here in a second, and we just have a look at the unemployed. Here it is right here, 5.694, call it 5.7 million. That gives us an unemployment rate of 3.4%. If there's another 5.3 on the sidelines that we're just not counting because they didn't do anything in the 4 weeks before the survey, but they do want a full-time job, they're potentially there. So that would bring the unemployed up to 11 million, which would almost double that unemployment rate from 3.4 to 6.8%. Layer on top of that, the 4.1 million who are working part-time for economic reasons, you're at 15 million potential employees. And we're looking at an unemployment rate of 5.7. Not in labor force, you notice that the not in labor force increased over the course of the month. And we'll come back to these numbers here, the 159 to 160. This is employed. Now, remember, there was a population adjustment. You can't just compare these two numbers. You must first look at what the employment adjustment was, and then you can get the actual increase. Let's just keep that in mind here, that we have this 5.3 million and this 4.1 million over here. A couple more things here to read. Adjustments to the population estimates for the household survey, effective with data for January 2023. Updated population estimates were incorporated into the household survey. The adjustments, this is the effect that the adjustments had. The adjustments increased the estimated size of the civilian non-institutional population in December by 954,000. The civilian labor force by 871. So let's just stop right there. The civilian labor force by 871. So when we come down here and we look at the 159 to 160, just the adjustment was 871,000 of that. So when we look at the number of people employed, it ends up being significantly lower, something like 20,000 or 23,000. I have the number on another screen. The civilian labor force by 871, employment by 810, and unemployment by 60,000. The number of persons not in the labor force increased by 82,000. Although the total unemployment rate was unaffected, the employment population ratio and labor force participation rate each increased by 0.1 percentage points just as a result of the adjustment. And that's what this was saying up here, that even though you saw 62.4 for the participation rate, after removing the effects of it, they were unchanged. So the participation rate was actually unchanged month over month. It was the adjustment that made it appear to be changed. All right, let's go to a screen where I have pulled together some of the more important numbers. Okay, from Table A, this is the household survey. And if we look at the line for those that are employed, those are the two numbers that I had highlighted in Table A, December to January plus 894. But we know that the population adjustment increased that number by 871, which means it increased by 23,000. So if we're looking at how many more people were employed in the household survey, it was 23,000. Table B, in the establishment survey, it was 517,000. And when I get to the seasonally adjusted numbers in the table down here, they don't add up. There's something wrong with the numbers that didn't make any sense to me, and I checked and rechecked my numbers, but they don't add up. So I started thinking, well, let's look at the non-seasonally adjusted, see where I get there, because some of these, they just seem way out of left field. No one was expecting 517. No one was even close to 517. My reaction when I saw the 517 was, whoa, and I was listening to Bloomberg after, and almost everybody they had on after said the same thing, that their reaction was, oh my God, wow. And no one was expecting this number. 517, average weekly hours increased to 34.7. Average hourly earnings increased by 3.7% on an annualized basis. So if you take month over month and annualize it, 3.7. So people working more hours per week and getting more pay per hour. If you combine the two, average weekly earnings are up 15.1% on an annualized basis, and that speaks to aggregate demand. So if we feel that supply has been coming more in line with demand, well, aggregate demand on an annualized basis based on January jobs data has just increased by 15.1%. Temporary workers, which October, November, December were all negative, showed a positive number for January, up almost 26,000. Overtime hours expanded as well after coming down for a number of months, down to 3 hours, is now 3.1. Overtime is primarily manufacturing, is up to 3.1. We know that average hourly earnings is affected by the mix of workers. You could still have wage inflation, but if you keep switching to lower cost employees, in other words, younger employees with less education, you can lower average hourly earnings just by the mix. So let's have a look at the mix. Less than high school showed a job loss of 26,000. Those who have just high school, 497. Some college or an associate's degree, that's community college, 314,000. A bachelor's or higher actually dropped, negative 356. Well, the cost of employees increases as you move this way, so the bulk of the jobs are below the bachelor's level, and you have losses going on over here. Full-time jobs added 278, part-time jobs on a full-time equivalent basis 606. So again, skewed more towards part-time and skewed more towards younger workers and younger workers with less education. Let's look at this chart here. We're going to look at the not seasonally adjusted and the seasonally adjusted. Because if this is not like any other business cycle, those seasonal adjustments might be distorting the underlying story. So let's have a look. Total 16 years and over. We saw in Table A the employment from December to January increased 894. It should be the same number. It's 894. Good. There's a nice check right there. We were dealing with the same number. And then we can look at the indentations, right? This here and this are the next layer down. So the sum of these two should add up to the line above it. So we have plus 30 and plus 864 adds up to 894. Everything is good. This is the next indentation here. The sum of these should add up to the line above it. We have negative 106 in the 16 and 17-year-old category, but in the 18 to 19-year-old category, it increased by 150, which is a net increase of 44. We only have 30. So I'm thinking, well, it should add up. It should add up to the category above it because it is complete. It's not as if we're missing something like 17.2-year-olds. It is complete. It is the whole range. It should add up, and it doesn't. So I thought, well, okay, so maybe I'm missing something. Let it go. Then we have down here the 20 and 25-year-olds. Well, the 20 to 24 and the 25 and older should add up to 20 years and older because, again, it is complete. We have plus 871 and plus 357, which is about 1.2 million, does not add up to the 864. So I check the numbers again, and I'm right. I check my calculator. I watch it very carefully. I key in the numbers. I look at it. I look at this number. I say, okay, everything is fine, and I still get the same thing. So I can't recover this number, but I can recover everything else. All these other ones I can recover, but this level here does not add up to the level above it, and this level here does not add up to the level above that. Odd, I thought. Very odd, because they should add up. If you dump this in a spreadsheet, it should add up, and it doesn't. So, it starts bothering me some more. I thought, well, let me just look at the not seasonally adjusted. Yeah, there are some issues in there because then you have to think about, well, what would have been the seasonal effect of this? And if it's not like every other business cycle, well, maybe it is worth looking at the non-seasonally adjusted. Total 16 years and over from December to January, negative 180. And we were told that it added 894, and you have negative 180. So that's like negative 1.1 million without the adjustment. If I go down to the 20 and over, I get plus 11,000, not plus 864. The 20 to 24 is 608,000. And the 55 and over, way down here, this last line, sorry, not 55 and over, everything else is negative 597. Well, that does add up, right? 608, negative 597 should get me plus 11. The retirees, the 55 and older, I assume that, if you're gone at 55 and over, you've retired, is 448 of the 597 was just in retirements. This tells me a completely different story, that it is not plus 23 after the adjustment, 180, negative 180 after the adjustment, and 20 years and over is plus 11,000, not plus 864. And again, the 20 to 24 is plus 608. Everything else is negative 597. So, combine it here. You have the bulk of the jobs in high school and less than BA, a bunch of them in part-time, a lot of them in the 20 to 24, with everything 25 and up losing 600,000, and those retiring, which typically would be paid the highest in their career because, you don't work to 55 and then your wage starts to drop. You work to 55 and maybe it goes sideways. They're leaving the workforce, 448. So it could be that average hourly earnings is picking up the fact that higher waged people are exiting the labor force and lower wage people are entering the labor force, which is still positive for wage inflation. But wage inflation is not happening, or wage deflation or disinflation is not happening because the labor market is slowly coming into better balance. It's happening because of a substitution effect. Much like you go to the grocery store and you say beef is too expensive, I'll buy pork. So it may keep the personal consumption expenditure measure of the cost of living lower because of the substitution effect, but that doesn't change the fact that the price inflation still exists at the level of beef. So this may not be changing the fact that the wage inflation may still exist at the level of the job, but that by substituting different individuals for that job, you might be able to pay them less. This is bothering me, the seasonally adjusted versus the non-seasonally adjusted. If I'm missing something, if anyone can see what I'm missing here, because if I'm missing something, it's got to be so blatantly obvious that I can't even see it anymore. But if I'm missing something here, somebody pointed out, I don't think it is that each series is itself seasonally adjusted such that it cannot add up. It must add up because this is the total. These are all sub-indices of a total index. It must add up. So I must be missing something, or there's something funny with the seasonal adjustments that just don't work this time around, because it just doesn't seem to match the stories in other parts of the economy. I don't know. What are your thoughts? Leave them in the comments section if you have any thoughts on this one. But it just feels that well, first of all, because of the adjustments, it's hard to look at the January numbers and compare them. But I am highly suspect of this number over here. I don't think that's a real number. I think that is the result of applying a seasonal adjustment using seasons that no longer apply to the season we have to be that we find ourselves in now. So it could be, let me just erase this, that when we're looking at seasonal adjustments, you got to get the right layer to erase it. So just to give you an idea of what a seasonal adjustment is, if we look at a series of sales, Q1 to Q4, it will look like this, right? So sales can be increasing and it does this. Well, there's your Q4 sales, which tend to be highest at Christmas time. So if you were looking at quarter over quarter, you'd say good, good, good. Quarter over quarter sucks. We had a decrease. We decrease, good, good, decrease, decrease, good, good, decrease, decrease, good, good. And you'd have all this volatility because of that seasonal adjustment. So if you add a lag for the fourth quarter, you can get something that looks like this, so that you can find the underlying trend without all of the seasonal adjustment. Well, what if we're looking at the past and it tended to look like this? And now, because of the pandemic, it started to do this. Well, if you're seasonally adjusting on this using a seasonal adjustment here, perhaps these seasons are no longer relevant anymore because you have a bigger force going on that knocks that seasonality out of play. And I think that's what's going on right now, is that the trend that could have been associated with normal seasonality is distorting the numbers, because I think we have something that is pushing normal seasonality out of the way and not capturing what's really going on, such that rather than having your seasonal adjustment have volatility, you keep going with the seasonal adjustment and you have your outcoming data showing the volatility. Well, if the outcoming data is showing this volatility, then there's something with the seasonal adjustment. You would not attribute it to anything, but when you're looking at the seasonal adjustment, you must say there must be something about the past that does not match what's going on today. And I think that's the problem we're having with this seasonal data, because this month was so far out of line that it just couldn't make sense. There had to be something. So it does not line up with the non-seasonally adjusted, even on a close trend basis. That everything just seems to be in the exact opposite directions, that it makes you think, what's really going on here? I don't know that I can trust these numbers. Anyways, again, leave your comments in the comments section. Maybe some of you out there have worked with this data much longer than I have, or much deeper than I have, and you may have some insight that you can share with me. I'm going to throw a summary screen into the video before I get to the S&P 500 chart and look at sort of a high-level view of where we are in 4 categories. And these are just very basic bullet points. I think for each of these, I could probably write a 2 to 3 page report on each one. The key in each one is that we're kind of mixed, which we would expect to be when we are in a low-growth environment. Because in a low-growth environment, there are lots of conflicting signals. Some indicators will show that, well, there is growth and expansion in some areas. Other indicators will say, no, we have negative growth and contraction in some sectors. And layer on top of that the compounding difficulty of being in a part of the business cycle after a shock that we haven't seen for 100 years. So it's hard to compare the stages of this business cycle with other stages. Financial indicators, we have multiple yield curve inversions, many with 100% track record of forecasting a recession. We have ongoing QT, so over the course of the year, from January 1st to December 31st, roughly close to $1 trillion will fall off the balance sheet. We've had a year of, 2022 was a year of negative growth in M2. And if QT continues on, you might see 2023 also being negative in terms of money supply growth. However, and this is a big one here, low option adjusted spread. The credit spreads are extremely tight. There seems to be no credit market reflecting partly the economy, that the way the labor market is strong and growth does seem to be there. Although low, it's still growth. It's not contraction. It's hard to imagine an endogenously induced recession with a strong labor market without a credit market crisis, without something happening in the credit market, which means that if we are going to get a recession from where we are now, it's going to have to be some exogenous event that hits the market. Unless there is some credit event somewhere that was unexpected that causes credit markets to run for the exits, it's hard to see how we can have that kind of recession. So all eyes on the credit market for now. In the labor market, we have a steep labor supply curve if we accept the seasonally adjusted data, but there is some reason to expect that the seasonally adjusted data is suspect. It may be adjusting for seasons that we are just not in, that this is a completely different season that's not matching the seasonality of the last 5 years or 10 years, that maybe you have to model the seasonality from previous exits of pandemics. Well, there just isn't a data set big enough for that. Even though we have a steep labor supply curve, we do see the ECI, the Employment Cost Index. That is the true measure of wage inflation because it holds the job constant. It's not concerned about the mix of workers. We see it dropping. Still elevated at 4%, but we do see it dropping. And now that 4% is the quarter annualized, which can be noisy. Whenever you take data from like 1 month and annualize it, that data can be extremely volatile. So if you draw out, month to month to month, if you take the 1 month change and annualize it, you'll get a very volatile series. It's better to take, 3 months and annualize it, or 6 months. Well, the ECI is quarterly. So if you take the quarter, it's not so bad. Annualize it 4%. It's still dropping, no matter how you want to look at it, no matter what argument you make. It is dropping. However, the real wage growth is still less than zero. It's been going into 2 years now where the real wage growth is less than zero. We have a low participation rate and a low unemployment rate. However, there are 5.3 million that are not counted as unemployed because they simply haven't met the technical definition of an unemployed person, meaning, hey, did you even look any time in the last 28 days? And if the answer is no, well, okay, so you don't have a job, you want a job, but you're not counted as unemployed. So if you remove the technical definition and you say, well, who really is unemployed? There's another 5.3, plus another 4.1 million that are working part-time for economic reasons, meaning they want a full-time job, they just can't find a full-time job. Well, given that we have the JOLTS report showed over 11 million openings, rising openings, elevated quits rate, meaning that people who have jobs are perfectly willing to quit their jobs because they can get another one very quickly. And you have low initial claims. So this here is a little bit more real. We don't have to worry about the seasonal adjustment there. It's a little bit more real. So it would indicate that, yes, we do in fact have a good labor market. Well, what's going on here? Why would 5.3 million say, well, I just gave up, I can't find a job, I want one, but I can't find one? Same with this 4.1. So perhaps we arrive at the conclusion that maybe they are structurally unemployed as the economy becomes less repetitive. In other words, routine type jobs have been replaced with automation. As the economy becomes less repetitive, less routine, and more specialized, maybe these people are simply just not qualified for any job that exists, and perhaps they just don't want to take a job that pays minimum wage. So we would call them structurally unemployed as opposed to cyclically unemployed. Cyclically means, yeah, the economy for what you have right now is not great, but it will come back. Structurally means the skill set you have is just not going to make it in the world that we're in and the world we're going to. That, yeah, sure, you're available and you want a job, but you just don't qualify for any of the jobs that are out there. That could be the case. And if they are structurally unemployed, well, then they are probably not going to help flatten the supply curve. The low initial claims, you can't argue with that one because you can actually count those. So even if you look at the non-seasonally adjusted, they're low by any standards. They're low. So that's usually a very good indication of how tight the job market is if there's turnover in the labor market, but you have very few people showing up for claims, meaning they can walk into another job rather easily. Let's look at the consumer. Retail sales growth has been negative month over month for November and December. We looked at them in this video series each time, and we just, as you scroll down the list of all the categories, you just see a whole bunch of negative signs. And if retail sales are nominal, because whenever you pay for something, it's not a real price that then they add inflation on at the cash register. The price you pay is the price you pay. It's a nominal price. If you adjust for inflation on a real basis, retail sales are negative year over year on a real basis. However, as we saw in January, aggregate incomes are now up 15%. That's a combination of average weekly hours being up and average hourly earnings being up. If you're getting paid more per hour and you're working more hours, your weekly paycheck is bigger by two factors, more per hour and more hours, right? So 15% on an annualized rate in January. And one thing you can count on with the American consumer is they will spend the money they make. So that is a potential aggregate demand there. Savings rate is down, however. Credit card balances are up. However, we do have strong household balance sheets. Working against all of this, interest payments are now about 2% of disposable personal income. This is non-housing interest expense, because we have credit card balances increasing. On the 15th of this month, I think it's the 15th, we get the quarterly consumer credit report from the New York Fed. That is going to be interesting. We'll get that for the fourth quarter. We saw in the third quarter that credit card balances increased at the fastest rate in something like 20 years. It was 15% on an annualized basis for the quarter, or maybe it was just for the quarter. I forget what it was, but I do remember it was the fastest increase in credit card balances in at least 2 decades. So let's see what happens to credit card balances this month. That'll give us some insight into how the consumer is coping. And if we see that they're relying more and more on credit to get it done, then interest payments are going to become a larger and larger part of their disposable personal income. If we take the Fed at its word that they're going to keep rates higher for longer, you have a couple of scenarios, right? You could say, well, we're entering a period of expansion. Well, if the economy is going to be fine and move upwards, where's the motivation to lower rates? There's no reason to lower rates because, hey, they have two mandates, right? Price stability and the labor market. Full employment. And if full employment is there, they don't have to do anything to the interest rate for that. They're going to worry about inflation. And inflation does go down, they'll look at full employment and say, yeah, but why lower rates? Full employment is, we've got both boxes checked and rates are here. Why would we move them? So you'll have rates higher for longer, which is going to continue to affect the interest payment component, especially if debt is increasing. If you have a soft landing, and you have a low growth environment, where is continual growth going to come from? Right now we saw January, the labor report shows aggregate incomes are increasing, but we can't expect that 1 month rate will be what we'll see every single month. That we still might be looking at an anomaly of the adjustments that haven't worked its way through the system yet. Maybe when we get the February jobs report, it may have a bunch of corrections to January and may revert to something more in line. On the business side, PMIs, mixed here. Manufacturing, they're still showing contraction and dropping, especially new orders. And services, they are increasing. There was a big increase in the on Friday we saw for PMI services is increasing. This is where the Fed is saying that's where we're seeing no disinflation yet, is in services ex housing, and the PMI is not really helping in that respect because it has expanded and prices in services moderated just a little bit. In manufacturing, they actually increased, even though the other sub-indices were still pointing at contraction. So if prices have increased over here where we were getting deflation to help with headline CPI and core CPI, I don't know that it's going to work out on the services side with the slight decrease. So maybe the next CPI report we see, because this was PMI for January, and if you look at the prices sub-index in the manufacturing PMI, we did see it actually went up. The CPI on February 14th will be interesting. Earnings and guidance is mixed. Some companies are really hitting it out of the ballpark, and some companies are coming in sort of light. We saw Thursday night, the reason futures were negative, they weren't just pulling back in front of a jobs report. You had Google, Amazon, and I forget the other company. There were three tech companies, Apple, where it was not so good. Amazon wasn't good at all. Ford really shit the bed on that one too, which is, coming off the back of GM really hitting it out of the park, Ford really missing. So you had some companies that, when they were good, and other companies weren't so great. However, the forward EPS is dropping. We'll see shortly. There was a big drop week over week in the forward EPS, so that's not too good. Last GDP report, we saw inventories increasing, investment decreasing, and that's not good for growth either. And the leading economic indicators index is not just flashing a recession warning, but now a recession signal, and it has a 100% track record of this signal. In the last 6 months, if it drops by a certain percentage, I think it's like anything more than 4% in the last 6 months has always led to a recession, and we're past that negative 4%. So we are seeing in each of these categories, some things that are okay, some things that are not. So we're sort of mixed. So let me draw you a picture of what I think is going on in the economy right now. And this is, we can think of a river, right? You're coming off the ocean and you're going into a river, and it's a very narrow river. And on one side, we have a recession, and on the other side, you have the expansion. And this is where we're going right now. This is the pathway that the Fed is trying to engineer, is a soft landing for a period of time until inflation comes down. If we get too close to this bank over here, the thought is that inflation will just start to creep up, and that means rates will have to go higher. Well, that is negative for everything, negative for stocks and negative for bonds. So you'd want to be short beta and short duration. However, in being short beta over here, I seem to think that you'd probably want to have a small beta exposure to growth, because you would be getting growth, and margins usually are wider for growth companies than they are for value companies. If we drift too far to this shore, well, obviously you're heading towards a recession, and that would lower inflation, which would lower rates, would be positive for bonds, but it would be negative for the market as a whole. And if we navigate this course right in the middle of the river without getting too close to the recessionary bank or the expansionary bank until inflation is out of the way, you got to believe the Fed rates will be higher for longer. And if they are higher for longer and we are in a low growth environment, well, then it's the multiple that you have to worry about. Because right now we're at 18.7 times forward earnings, and forward earnings are dropping. What is interesting is the last 2 weeks, the multiple on the market has gone up while the earnings has gone down. I shouldn't say the multiple on the market has gone up, because obviously that's how the multiple goes up. The S&P index has gone up, showing that the market is willing to pay more for the index while earnings have come down. In other words, the market is saying we want to pay a higher multiple for shrinking earnings. We're okay with that, I guess, because there's some belief that we will hit the expansionary shore, go up, inflation will, as the term I've heard quite aptly, will immaculately disappear, and everything will be just fine. I just have a hard time believing that this shore will be just fine, and I think that this shore is probably more likely, but we could continue down the river, meandering from shore to shore for a couple more quarters at least. So I think we are range bound overall, which means sort of a neutral stance. I think that if we get too close to the expansionary shore, meaning the indicators are pointing to growth and the market is responding, I would be very contrarian in these markets and be short beta. And if we get too close to this shore over here, I would probably be short beta and long duration. And it just seems that if we go down the middle, I'm neutral. So I cannot find a way that I'm going to suddenly drop any short position and just jump in and be straight long on beta and overweight growth. I'm just not seeing it at this point. So I am still short beta. I am still long duration because I think that we're somewhere going to be here in the middle of the river or downwards, but I just see moving into expansion at this point, causing stresses that would probably not end well. Okay, let's have a look at where we are in the market. Forward 4-quarter EPS. This is from S&P Global. Link is in the description box below. You can download the spreadsheet I showed you last week on which cell to find the forward 4-quarter EPS on the first tab. 221.01. Last week was 223.63. That's a drop of 262 in 1 week, which is a fairly significant drop in 1 week. SPX closed at 41.36.48, which puts us at 18.7 times forward estimates. And it is important to say that word estimates because it is an estimate. So the market may be looking at that saying, well, we don't believe the estimate. We think the estimate is much higher. It's not that we're paying 18.7 times forward earnings. The market may think we're paying 17 times forward earnings because forward earnings are really much higher than that. They may be deciding that that's what the end result is, or they may be anticipating that, okay, well, maybe that is your forward 4-quarter EPS, but you'll be adjusting them upwards, right? Once we get second quarter, third quarter, you'll really be adjusting them upwards, right? When the Fed pivots, right? Maybe that's what they're thinking. In the week coming up, we got 90 more companies reporting. I think we're somewhere around halfway through. June ES ended at 41.8250. Notice where the SPX is, 41.3648. So there's 46.02 of carry. This carry drops every week because interest times time makes a straight line. Unless the interest rate changes, then of course you get changes in the direction of interest, but it basically decays at a fairly linear rate. I did sell 40-50 puts on June ES at 122. So not only do I think I had like some 50 points of carry when I entered, still got 46 points of carry here, just added another 122 points as well. My average cost on my short position now is 41.20. You have to be if you're going to have a short position, especially on the index, you must be very tactical. So it's not a short and hold. It's you short and cover, short and cover, short and cover. Not your whole position all the time, but you have to increase your short position as the market comes up and decrease as it goes down. You have to get very tactical. I sold 50% of my ES position with puts. When I say sold 50%, I still have my full short ES position, but I sold puts on 50% of that position at 40.50. My average short is 41.20, so it's 70 points down to 40.50, and I'm short, so that's good, and I get another 122 out of that. When I look at my position and where do I get concerned about my position? I don't compare the 41.82 with my average cost of 41.20 because there's 46 in there that I'm going to get anyways. Like I'm going to get that anyways. As time goes by, I'm going to get that. So when I try to determine, well, how much trouble am I in, I compare the closing price with my average price. And I note that I am 16 points underwater. On your P&L in Trader Workstation, it will show that you are 62 points under, and it will multiply that by 50, and it will multiply that by the number of contracts you have, which will show a negative number of what you're down by. However, time will give me that on its own. In other words, there's no uncertainty about that carry. I'm going to get the carry. And since I've added another 122 on 50%, which means I've added 61 points on my full position. If I add the 61 to the 41.20, my break even is now at 41.81. We're at 41.36. I think about it that way. I don't think about how much, I don't look at this negative number over here because it includes the carry. And since I know I'm going to get the carry anyways, it's just I haven't earned it because time hasn't passed. I don't think about it as, well, maybe I won't earn it. Yes, I will earn it. I will get it. I just have to wait for it. But every day I get a little bit more carry in my favor. So I compare my average with where the index is. 18.7 times. Let's just do the inverse of that. You get a 5.34% yield. Earnings yield. 6-month T-bill is 482. 1 to 3 year category for investment grade is paying 4.9 right now. High yield is 7.56. So you have a market that is not much more in terms of the reward for taking on distribution risk, because the market, of course, has some expected return, but there's a huge distribution of outcomes, right? You're getting 44 basis points to take on that risk above investment grade. Above a T-bill, what are you getting there? 52 points, 34 and 18, 52 basis points. typically you'd expect to see 3, 4, 500 basis points. You're getting 52 basis points. So by yield basis, this market is overvalued unless there's a belief that no, we're here. This is the distribution that we're going to get, not this point estimate here, but this distribution. So really, we're not overvalued because this 221 should be 250 perhaps. So this 18.7 is really 16. Maybe the market is thinking that. 18 times brings us to 396 on the SPY, or 3960 roughly on the index. What is that? About 190 points down, 180 points down. And 17 times. Remember when we were talking about 17 seems like the right number? That's 3730 or 373. S&P is above both the 200-day and the 50-day, and the interesting thing about, there was a crossover where you had the 200 and the 50 crossed above the 200. That's called a golden cross. They are now sitting, this is interesting, as of the end of the day, they are sitting identical. The 200-day and the 50-day are at the same price. I think they're off by like a penny or something, but they're basically the same price. So you had this happen on Friday, so that was perhaps a false breakout above the 200 to make the technical traders out there a little happy that I'm speaking a bit of their language. Implied volatility creeped up just a little bit, 3%, 2%, and 3% across the 13, 26, and 52. 3 up from 0, 2 up from 0, and 3 up from 2. Still, I mean, really, it's nothing to get excited about, but it did creep up a bit. Friday's put-call ratio was 1.29. Put-call open interest now is 2.27. Last week is 2.07. When you have implied volatility this low and you are long the market, buying puts is super cheap. So there might be some idea that, well, how much upside could there be? Could there be another 100 points? Could it get to 42.50, 43? And maybe you're thinking, well, maybe it could, but I really don't know. But I'm a long-only fund. What can I do? I'm a long-only fund. I got to stay in the market. But what I can do is lean into it if I think it's going to go up 100, 150, and buy these puts. If I buy these puts, it allows me to lean into this. Because if I'm wrong, well, my puts will cover it off. If I'm right and I overweight it a little bit, well, okay, the overweighting, the performance on the overweighting might pay for the puts. So, to see the put-call ratio increase, if there was a wide conviction that this is a new bull market, that would not have increased. Why would you buy protection if you believe that the bottom is in and we are in a new bull market? You buy protection when you're concerned. That put-call open interest increased week over week by quite a bit. That's basically a 10% jump, right? Going from 2.07 to 2.27, 10% is 20.7. Yeah, you're up almost 10% on the open interest on the put call ratio. That's significant. Implied volatility, last reading was 16.2. That's really low when you think about over here back in October, you were up around 28%. We're sitting down just above the 16% point at 16.2. So that's basically where we are right now. I have long positions that I've been paring back. I think home builders have had a great run, but I mean, where can they go at this point? If we are going to have higher for longer, I think some of the forecasts that they have might have been influenced by the dropping mortgage rates since the beginning of October. Mortgage rates have simply come right down, and they might be forecasting it to drop even further. I don't see home builders going on to new all-time highs in this environment, so I am lightening up. Mining companies have been doing very well, but they had a good run, so lightening up there. Ford is interesting. That if I had to pick Ford and GM going forward, this may sound odd, but I'd pick Ford. Only because they really messed up. They know they have a problem, so they're going to be looking for efficiency gains everywhere they possibly can. They're not going to allow this to continue. So I think that's as far as who could outperform over the next 3 months, let's say, or 4 months. I think GM will probably outperform over the next 6 weeks, but I think if you took a 4 month or 5 month period, I think Ford would probably do very well, because they know they have a problem that needs to be fixed, and they're going to fix it, or at least they're going to attempt to fix it. So they could show more rapid improvement in their earnings than GM could. But as far as GM goes, I was going to abandon it as an income factory, because I thought, with a price war looming, I don't think I want to hang out there. But they seem to handle it well, and they guided well. So I don't know if they're going to get involved in a price war or not. Tesla seems to be backing off the price war. They did raise prices $1,000 per vehicle in the US. So they seem to be backing off of that. That price reaction to me seems rather curious. Went from 125 to 195 on increasing volume, without paying attention to the fact that, at the cost of margin. I mean, what does it matter if you increase, if you can double your volume, but if you half your margins, your EPS growth is zero. And if you're paying a multiple of EPS and you have zero growth in EPS, what does it matter what your revenues are if you're getting them at the cost of your margins? And in their guidance, I don't know if anybody even paid attention to their guidance for margins. They said margins greater than 20%. Q1 of 2022, margins were over 30%. Now they're guiding over 20%, because every quarter the margins have just gone straight down. And they're guiding now just over 20%, which could be as much as a 4 to 5% drop from where they are now, or what they had in the third quarter. But nobody seemed to pay too much attention to that. They just said, oh, you're back at 50% growth. Elon Musk said they're going to do this, and, well, he's always right? I mean, when he said full self-driving in 2014, we got it, right? I mean, 15, right? I mean, when he said it in 16, right? I mean, when he said it in 2017, right? I mean, when he said it in 2018, right? And the truck in 2020 when he said the truck. I mean, 2021 when he said the truck. I mean, 2022 when he said the truck. I mean, he's always right. His forecasts were absolutely right. What I find interesting is the full self-driving. That story has come out now, that the video they did, what was it, in 2018, 2019, where he was narrating, saying what you're seeing is a Tesla driving itself, was absolutely false. It wasn't even driving itself at all, that it was absolutely false. So, I don't know why the market is so eager to believe everything he says, when he seems to just make stuff up as he goes along. He says stuff just to say stuff. I don't know. But I think they missed that point. Either way, I've gotten way off topic here. So just to sum up and put a bow on this, I've moved more towards a neutral stance, not so much negative on my beta position. When I sold puts, these puts here, puts have negative delta. So when you sell a put, you end up with positive delta, which moves your delta beta dollars back towards zero. I'm moving into more of a neutral position at this point. If we do start hitting 19x, 19.5x, and we see that earnings for the week are, still following the trend of forward earnings dropping, then I'll probably move back into negative territory. And if we move up, well, I'll take some profit off of the puts that I put on, and of course that would increase my average cost on this one. I am looking for some new long positions. However, I just haven't found a sector of the economy that I feel comfortable with going in at this point. I think I've picked my winners in October. They've done very well. Now I'm looking at, well, okay, what do I see for the next year? And I just don't have a lot of visibility right now because there's good data and there's bad data, and it almost seems balanced at that point. But that's what you would expect on your way, from a slowdown into a contraction. You are going to go through the soft landing neighborhood, and all the data will look like, we seem to be in a soft landing. It's neither too bad nor too good. The more important thing is not where we happen to be, but where the momentum is. So if we look at where indicators are pointing to, they are pointing downwards at this point to a contraction. Some of the indicators are good, some are bad, but that is exactly what you would find when you're in that neighborhood. So it's more of the momentum and the movement in it that seems to indicate to me that we have some downside on the economy. Let's have a look at the economic calendar for next week. So on the economic front, there just isn't a lot this week. For Canada, we have the jobs report on Friday. But overall, on the economic front, it's going to be a very slow week. Most of the big data, when I say big data, the household and credit report from the New York Fed is out next week. And CPI is out next week. This week is kind of dull. And next week, a lot of housing data as well. So if we scroll down here on Tuesday, you get balance of trade in Canada, balance of trade in the U.S. In Canada, it's more important because we haven't seen the December GDP number yet, so we get some little insight here. But in the U.S., we've seen Q4 GDP report. This will just fine-tune the number a little bit. And then later that day, Federal Reserve Chair Jerome Powell is talking at 12:40. 5 minutes later, not to be outdone, Bank of Canada Governor Tiff, T-I-F-F, Tiff, his name is Tiff Macklem is speaking. 3 o'clock, you get consumer credit change. This is not the household and consumer credit report, that by the New York Fed for Q4 of 2022. We get that next week. Some more Fed speak the next day. Really nothing exciting going on. More Fed speak over here. Here's our initial jobless claims. We get that every Thursday morning. There is Friday with the Canada jobs report coming out. Let's see if it follows suit with the U.S. Let's see if it comes with some really surprising number. The only big report here for the U.S. is consumer sentiment for February. We're sitting at 64.9. Let's see what that comes in. This is important as well. We know that they're paying attention to the 5-year inflation expectation. Not because they think the consumer is very good at predicting inflation 5 years out, but because the expectation gets built into wages. So that if that expectation is low, then the expectation of that expectation is that it is not embedded in wages and you don't have a wage price spiral. A little bit more Fed speak, and then that's it. It is the week is going to be dominated by earnings. And that is it.